Okay, welcome back guys. So this video I want to dedicate to evaluating the current state of the stock market with all that's going on in the world. So as I'm sure all of you guys know, last night, February 23rd, Russia officially invaded Ukraine. Now this did not come as any surprise. Over the past couple weeks, the fear of this has been adding a lot of volatility to asset prices. But even though over the past couple of weeks, the market has been pricing in this possibility, I have to say, just personally, watching these events actually unfold, a full-on ground war in Eastern Europe, is very shocking. And my thoughts and condolences definitely go out to the people of Ukraine. I hope they pull through this without too much damage. But getting back to the financial markets, we all knew that when the stock market opened, it was going to be in the red, and that's exactly what happened. But somewhat amazingly, intraday, the stock market rallied significantly and ended up 1.5% in the green, the Nasdaq 3.34% in the green. Now, a significant inflection point of this rally is when President Joe Biden spoke about the issue. And politically, a lot of people agree and disagree with the actions Joe Biden is taking, but without question, the financial markets really appreciated what he had to say, and I think that's for two main reasons. The first is it's exactly what we expected, and second, the administration said that they're going to do everything possible to try to minimize the economic impact of this conflict at home in the US. And in my opinion, that's what really helped the stock market to rally in the second half of the day. But it's not just the US stock market. Bitcoin also had an immense recovery throughout the day. And the reason why this is important to pay attention to is because Bitcoin is viewed as a very speculative risk-on investment. So the fact that this sharply went up today indicates that the sentiment is pretty bullish in the stock market right now. Also, the VIX, which is a measure of fear in the market, came down quite significantly throughout the day today. And to gain some more insights, let's come to my portfolio and filter by the past one day and see what we can learn here. So right off the bat, growth assets had a pretty significant rebound today off of their lows, and that's in contrast to value stocks, which up until this point have been performing better. If we click into this, we can see VUG is up 3.42%, BST over 4%, IGV 6%, and ARK almost 8% up today. And in comparison to that, Divo and JEPI are kind of flat, although over the past couple of weeks, they've done a much better job in preserving their value. But speaking of preserving value, I want to take a look at risk-managed funds because they haven't been performing super well during this most recent downturn. So this is a comparison of the S&P 500 and xrmi, which is based off the S&P 500, and it's a risk-managed income ETF. And as the name suggests, it's supposed to give you downside protection, but over the past 6 months, it's down significantly more than its benchmark. Over the past 1 month, it's still down more than its benchmark, and year to date, it's doing a little bit better. And if we switch over to the NASDAQ index, here we have the QQQ, qrmi, and NUSI. Even here, these risk-managed income ETFs have performed worse than their benchmark. So to understand why this is happening, we have to understand how these ETFs work. So the thing that gives them their downside protection is a simple put option. This is the same for NUSI, xrmi, and most other investments that have direct downside protection. And using xrmi as the example because they're the most transparent, every single month they buy a 5% out of the money put option. So that means within that given time, if the price goes below 5%, the put option comes into play and prevents any further losses during that time. Now these ETFs in particular give you downside protection as well as income because they use a collar strategy. So in addition to having a put option, they have a call option to generate income. But for the purposes of downside protection, the put option is really all that matters. And for those of you guys that are a fan of NUSI, I'm sure you're aware that back in March of 2020, when the markets dropped fast and hard, this ETF actually performed very well. And in this kind of a market situation where the price drops sharp and fast, this is where put options really shine. The key difference this time is that the market sell-off isn't happening within a couple of days. It's been happening over the past couple of weeks. And in this kind of a scenario where the market slowly bleeds out over time, put options are a lot less effective. And the reason behind that is very simple. So most of these ETFs buy put options once per month. As mentioned, xrmi as the example buys a put option 5% out of the money. So if the S&P 500 drops 6% during a month, it does save you from 1% of the downside. And then the following month, it buys a new put option, again 5% out of the money. So if the market continues to sell off and goes down another 6%, it will spare you from some of the downside, but you still experience most of the decline over time. And that's why put options perform their best during fast and sharp market declines of 30% in a couple of days. When the market is going through a multi-month long bleed out, these ETFs, just by their nature, are going to be less effective. Now, I personally prefer Divo and JEPI as my more safe haven assets, even though they don't have direct put options. And that's for a couple of reasons. The first is that the general assets that these ETFs invest in are very safe, stable, large, and secure in nature. Second, they implement call options as well as some dividends to generate a high level of income, and that relatively stable base level of return can help to offset potential losses in the price. And finally, Divo and JEPI have a more tactical approach to their covered calls, so not all of their assets have options on them, limiting potential upside. And what that translates to is that if JEPI and Divo do go down, say 5%, it's a lot easier for them to go back up 5% versus, say, xrmi, which sells at the money covered calls on all of its holdings. And taking a look at this chart, I believe that's the reason why we see Divo and JEPI significantly outperforming NUSI during this time of high volatility in the market. So that's my little update on what's going on with the stock market and why some risk-managed income ETFs aren't performing super well in this time of high volatility. I have absolutely no idea what's going to happen with the conflict between Ukraine and Russia over the next coming days and weeks. All I know is that the US stock market has proved itself to be extremely resilient. Currently, the VIX is just over 30 points, and historically speaking, when the VIX spikes like this indicates great buying opportunities in the market. So personally, if this continues to trend higher in the coming days and weeks, I will be adding to my portfolio. But that's just my stance on what's going on. Definitely leave a comment down below. Let me know your thoughts on the whole situation right now. It's kind of crazy. Hope you guys enjoyed the video. If you did, and you're still watching, leave a like, subscribe, all that kind of YouTube stuff, and I'll see you guys in the next one.